Hey, what's up everyone? It's Stack and Save. Welcome to the channel where we help young investors achieve financial freedom. The news is filled with talks about inflation, interest rates, and market volatility. It can feel like the entire economy is on shaky ground. But here's the thing, recessions are a natural part of the economic cycle. And while they can be scary, they also present some of the best opportunities to grow your wealth. We're diving deep into investment strategies specifically designed for young investors to not just survive but thrive during a recession. Let's get started. Alright, so you want to build a portfolio that can withstand a recession? The first thing you need to understand is the power of diversification. Imagine putting all your eggs in one basket, one single stock, one asset class. What happens if that one thing fails? You lose everything. That's why diversification is crucial, especially during uncertain economic times. Think of it like this. You're building a financial fortress, and each different asset class is like a wall protecting you from market volatility. You want strong walls surrounding your wealth, and that's what diversification does. By spreading your investments across different asset classes like stocks, bonds, real estate, and even alternative investments, you're essentially creating a safety net for your portfolio. Now let's talk about stocks. When it comes to stocks, you don't want to put all your money in just one or two companies. Instead, you want to diversify across different sectors and industries. Don't just chase the hype train of the latest tech IPO. Think about it. During a recession, people still need access to essential goods and services, right? That's where consumer staples come in. These are companies that produce things like food, beverages, household goods, and personal care products. The things people rely on no matter what the economy is doing. These can often be more stable investments during times of uncertainty. And hey, people still get sick, even during a recession. That's why healthcare can be a good sector to consider as well. Think about companies involved in pharmaceuticals, medical devices, and healthcare providers. These companies often see consistent demand, regardless of the economic climate. Now let's talk about bonds. Bonds are like the reliable, less volatile, older sibling of stocks. They're essentially loans that you make to governments or corporations, and they tend to pay out a fixed interest rate over a set period. So you want to know the secret to navigating a recession like a pro? It's all about finding those recession-resistant industries, the ones that keep chugging along even when times get tough. Remember, people still need certain products and services no matter what's happening in the economy, and that's where these recession-proof industries shine. Let's start with healthcare. It's a no-brainer, right? People get sick, need medical attention, and rely on medications regardless of the economic climate. This makes healthcare a historically strong performer, even during recessions. We're talking about companies involved in pharmaceuticals, medical devices, healthcare facilities, and health insurance. These are essential services that people depend on. Next up, we've got consumer staples. Think about it. Even during a recession, people still need to eat, drink, brush their teeth, and clean their homes. These are the everyday essentials that people just can't live without. So companies that produce food, beverages, household goods, and personal care products tend to weather economic storms quite well. Now let's talk about utilities. These are the companies that keep the lights on, the water running, and the gas flowing. Utilities are essential services, and people need them regardless of whether the economy is booming or busting. This makes utility companies relatively stable investments even during times of economic uncertainty. And hey, even in a recession, people still need to get around. That's where the transportation sector comes in. We're not just talking about airlines, which can be hit or miss during tough times. Think about companies involved in logistics, shipping, and railways. Let's talk real estate, an asset class that's near and dear to my heart. Now you might be thinking, real estate during a recession? Is that really a good idea? And the answer is, it can be. While real estate can be cyclical, meaning it goes up and down with the economy, recessions can actually present unique opportunities for savvy investors. Here's the thing, during a recession, property values can decline. This might sound scary, but it can actually be a good thing for investors who are prepared to ride out the storm. Think about it, when prices drop, it creates an opportunity to buy properties at a discount, potentially setting yourself up for significant gains when the market recovers. And remember, people always need a place to live, right? Even during a recession, people need housing. This means that residential real estate, especially rental properties, can provide a steady stream of passive income, even when other investments might be struggling. Now let's talk about commercial real estate. While this can be more volatile than residential real estate, it can also offer compelling opportunities during a downturn. Think about properties like essential retail centers, medical buildings, and logistics hubs. These types of properties often house businesses that are considered essential, meaning they tend to have more stable occupancy rates even when the economy weakens. But here's the key to successful real estate investing during a recession: due diligence. It's more important than ever to thoroughly research properties, analyze market trends, and understand the local real estate landscape. You want to make sure you're buying properties at the right price, in the right location, and with the right potential for long-term growth. Let's be real, trying to time the market perfectly is like trying to catch lightning in a bottle. It's incredibly difficult, if not impossible, to consistently predict when the market will go up or down. That's where dollar-cost averaging comes in. It's a simple yet powerful strategy that can help you navigate market volatility and come out ahead in the long run. Here's how it works. With dollar-cost averaging, you invest a fixed amount of money at regular intervals, regardless of what the market is doing. This could mean investing weekly, bi-weekly, or monthly. The key is consistency. By investing consistently, you're essentially buying more shares when prices are low and fewer shares when prices are high. This averages out your cost per share over time, potentially reducing your overall risk. Now, dollar-cost averaging won't magically make you rich overnight. It's a long-term strategy that requires patience and discipline. But over time it can be a powerful way to build wealth steadily and reduce the impact of market ups and downs on your portfolio. And the best part is, dollar-cost averaging takes the emotion out of investing. You're not constantly checking the markets, trying to guess the perfect time to buy or sell. You're sticking to your plan, investing consistently, and letting the power of compounding work its magic. Let's talk about Warren Buffett, the Oracle of Omaha, one of the most successful investors of all time. He's seen it all: multiple recessions, market crashes, and economic booms. And you know what? He's consistently come out on top. And one of his key strategies for navigating downturns is simple: be greedy when others are fearful, and fearful when others are greedy. What does that mean exactly? Well, during a recession, when fear and panic grip the markets, that's when Buffett starts looking for opportunities. He knows that when everyone else is selling, that's often the best time to buy. Why? Because fear often drives prices down further than they should, creating bargains for those who are willing to keep a cool head. Buffett is a value investor. He looks for undervalued companies, businesses with strong fundamentals that are temporarily out of favor with the market. He's not afraid to go against the crowd and buy when everyone else is selling. One of Buffett's most famous quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." What he's saying is that quality matters. During a recession, it's even more important to focus on companies with a proven track record of profitability, strong management, and a competitive advantage. These are the businesses that are more likely to weather the storm and come out stronger on the other side. But Buffett's success isn't just about buying low and selling high. It's also about patience. He's a long-term investor. He's not looking for quick flips or get-rich-quick schemes. He's content to hold on to his investments for years, even decades, letting the power of compounding work its magic. That's it. You've made it to the end. Now you're armed with the knowledge and strategies to not only survive, but thrive during a recession. Remember, while recessions can be intimidating, they also present incredible opportunities for those who are prepared. By diversifying your portfolio, exploring recession-resistant industries, considering real estate, using dollar-cost averaging, and learning from legends like Warren Buffett, you can potentially come out ahead. If you found this video helpful, hit that like button and subscribe to the channel for more videos on personal finance, investing, and building wealth. And don't forget to hit the notification bell so you don't miss out on any future uploads. Thanks for watching, and I'll see you in the next one.